I want you to close your eyes for a second, just for a moment. Imagine you're a pilot. You're sitting there in the cockpit of a massive jetliner, cruising at, say, 30,000 feet.
Hmm.
You've got a hot cup of coffee in one hand. You look out the window, and the sky is just this perfect, piercing blue. You're feeling pretty good about the flight path. Everything seems smooth.
Sounds like a perfect day for flying. The dream scenario, really.
It does, right? Until you happen to glance down at your dashboard.
Yeah.
And that's when the cold sweat starts to kick in. Because the dashboard isn't just malfunctioning. It's telling you 3 or 4 completely contradictory stories all at the same time.
Which is pretty much a pilot's worst nightmare. I mean, that's the one thing you rely on, your instruments.
Exactly. So you look at your altimeter and it's just screaming at you. It says you're in a nosedive, plummeting toward the ocean, and you've got seconds to pull up. You're hearing terrain in your headset.
Okay, so total panic.
Total panic. But then you look over at your speedometer and it says you are accelerating straight upward, breaking speed records, like you're strapped to some kind of rocket.
So one gauge says you're crashing, and the other one says you're going to the moon. They can't both be right.
They can't. And then you tap the fuel gauge to see if you have enough juice to even figure this mess out, and the needle just snaps off and falls to the bottom of the glass.
And that, unfortunately, is not just a terrifying scenario for a pilot. That is a frighteningly accurate description of the global economy right now. We are all flying blind.
Welcome back to the deep dive. Today, we're trying to figure out how to land this plane without crashing it into the side of a mountain. We have a massive stack of research today. We're talking charts from the Federal Reserve, data sets from the bond market, and some very, very confusing signals from overseas.
And our mission really is to answer a question that has been driving every economist and every fund manager completely crazy for the last 2 years.
Which is...
Why hasn't the plane crashed yet?
It's the central mystery of this post-COVID world. We are witnessing what economists are calling a breakdown of correlations. All these indicators, these gauges that have successfully predicted every single recession for the last 40, maybe 50 years, they're suddenly failing.
They're all flashing red, screaming, danger, pull up.
Yeah.
And yet, the economy just keeps chugging along. It defies gravity.
So we're going to look at that broken crystal ball today, try to figure out why the old maps just don't seem to work anymore. But we're also going to look at the engine that's keeping us in the air, which, as it turns out, is a terrifying addiction to debt that has created what some of our sources are calling a Frankenstein economy.
It's an unnatural state of being. It's stitched together from parts that shouldn't work together, and it's being kept alive by artificial electricity. And we have a genuine shocker buried in the data today that we have to get to.
Oh, yeah.
We're going to discuss a specific metric, a kind of risk gauge used by the biggest banks in the world, where the United States government is currently viewed as a riskier borrower than Italy.
Or Portugal, or Greece.
Or Portugal, or Greece. Yeah.
That one, I have to say, it actually blew my mind when I was reading through the notes. The U.S. is riskier than the country that literally gave us the Eurozone debt crisis. We're definitely going to unpack that.
And to really understand the U.S. situation, we also have to look across the ocean at our friends in Japan, because they are the ghost of Christmas future for our economy.
So it's a tale of 2 debt bombs.
It is. One is ticking in Tokyo, and one is ticking in Washington. And the scary part is that they're dangerously linked.
All right, let's get into it. Let's start with this broken crystal ball. Because for decades, economists have relied on this one particular thing called the LEI. And if you're not a finance nerd, you probably have no idea what that is. So let's start right there. What is the LEI?
The LEI stands for the Leading Economic Indicator. It's published every month by a group called the Conference Board. And you can think of it as the ultimate dashboard warning light. It's not just one thing. It's a basket of 10 different metrics that are all bundled together to give you a single score, a single line on a chart.
Okay, so it's like an economic smoothie. You're throwing a bunch of different ingredients into the blender to get one overall picture of health. What's in the blender?
It's a mix of everything that signals future activity. That's the key word, leading. It looks at things like manufacturing new orders. So, are factories buying steel today to build cars 6 months from now?
Makes sense.
It looks at consumer expectations. Do people feel rich and confident, or do they feel poor and scared? It looks at building permits for new homes, the performance of the stock market, credit conditions. Basically, it takes the pulse of the entire economy to try and predict what's going to happen down the road.
So it's the weather forecast for the economy.
Yeah.
It tells you if you should pack an umbrella for next quarter.
Exactly. And historically, this thing has been a sniper rifle. just doesn't miss.
Yeah.
If you look at a chart of the last 40 or 50 years, every single time the LEI line drops below a certain negative threshold, a recession follows almost immediately.
And when you say recession, you mean those gray bars you always see on the economic charts?
Those gray bars. It's practically clockwork. You see the drop in the LEI, and boom, a gray bar appears on the chart a few months later. Every single time.
But that's the whole point of today's deep dive. That's not what's happening now.
No. And this is the massive anomaly that has everyone, and I mean everyone, scratching their heads. Since early 2022, so for years now, the LEI has plummeted. It's fallen off a cliff. It has been signaling a guaranteed deep recession for nearly 3 years.
So if you had followed the manual, if you were a pilot who trusted that one gauge, you would have made a decision based on it.
You would have sold all your stocks, you had bought gold, maybe moved into a bunker in 2022 waiting for the crash.
But if you did that, you would have missed out on one of the biggest stock market rallies in recent memory. Because then we look at what's called the coincident indicator, which measures what's actually happening right this second, things like payrolls and personal income, and it's flat, maybe growing a tiny bit.
It's certainly not crashing. It's not in nosedive. So the forward-looking gauge is screaming, Mayday, but the current reality gauge says, we're flying level.
So is the crystal ball broken? Is the dashboard just fundamentally malfunctioning?
That's the big debate. Some people think that data gathering is flawed post-pandemic, but the more likely explanation, and the one all our sources seem to be pointing to, is that the LEI isn't broken, it's just obsolete. It was designed for a standard business cycle.
And a standard cycle meaning, a regular economy where people and businesses buy and sell things based on their own finances.
Right, an organic economy. It was designed for the economy we had from, say, 1980 all the way to 2020. It was not designed for this new paradigm of what they're calling fiscal dominance.
Fiscality, that was the word I kept seeing in the research. And that's really just a fancy way of saying government spending, right? Deficit spending.
Precisely. The LEI is designed to look at the organic health of the economy. It looks at whether businesses are ordering new machines or if consumers feel confident enough to go buy a new car. And the thing is, the LEI is right. The organic economy is weak.
Oh, so the gauge is working? It's just measuring the wrong thing.
It's measuring the patient, but it's not measuring the medicine. Manufacturing has been in a slump for over a year. The housing market is basically frozen because of interest rates. Consumer sentiment is terrible. The LEI is picking all that up correctly.
But the recession hasn't hit.
Because the LEI doesn't have an input for the government injecting trillions of dollars of deficit spending directly into the veins of the economy. It's an external force that scrambles all the natural signals.
It's like measuring the health of an athlete. The LEI is a doctor checking his pulse, his muscle mass, his respiration, and saying, this guy is exhausted. He's going to collapse at mile 10 of this marathon.
Right, all the internal signals say he's done.
But the LEI, the doctor, isn't accounting for the fact that there's a guy in a golf cart driving right next to the runner, injecting him with a massive dose of adrenaline every 4 hours.
That is a perfect analogy.
Yeah.
The athlete is exhausted. Structurally, the body is failing. But the chemicals are keeping him running, making him look strong on the outside. And we see this disconnect, this paradox, everywhere we look. Just take the consumer confidence numbers.
Right. This was another really weird one in the notes. Consumer confidence is in the toilet. I mean, it's at pandemic-era lows.
It is incredibly low. It's as low as it was during the depths of the 2008 financial crisis in some surveys.
So if you go out and ask regular people on the street how they feel, they say they feel terrible. They say inflation is crushing them. They're worried about their jobs. They think the country's on the wrong track. But then you look at GDP, the gross domestic product, and it's flying high. The Atlanta Fed's GDP Now tracker was showing something like 3.7% growth recently.
Which is a boom time number. 3.7% is huge. It's a very, very strong economy, on paper.
So here's the math problem. The U.S. economy is, 70% driven by consumer spending? So if the consumer is depressed and feels broke, they shouldn't be spending. And if they aren't spending, GDP should be going down, not up. So how do you get record high GDP with depressed consumers? Who is buying all this stuff?
Well, part of it is that what people say in a survey and what people do with their credit cards can be two different things. We do still see spending, even if people are unhappy about it. But the much bigger factor here, the real needle mover, is something we could call corporate quantitative easing.
Corporate QE. Okay, unpack that for me, because usually QE, quantitative easing, that's something a central bank does, the Fed.
Right. But we aren't seeing the average person driving this growth by going out and buying a new boat or renovating their kitchen.
Right.
You have to look at the very top of the food chain, the Magnificent Seven, the big tech giants like Microsoft, Amazon, Google, Meta. They have collectively allocated something like $700 billion for CapEx.
CapEx being capital expenditure.
Capital expenditure. That's the money they spend on long-term assets,
Yeah.
building new things.
So that's building massive data centers out in the desert for AI. It's buying tens of billions of dollars worth of chips from NVIDIA. It's upgrading energy grids to power it all.
Exactly. That $700 billion is a massive, massive injection of money directly into the economy. It boosts the GDP number significantly. When Microsoft goes and spends $10 billion building a new server farm, that registers as economic growth just as much as millions of people going out and buying new jeans.
So the economy, the headline number, looks fantastic because Microsoft and Amazon and Google are in a spending arms race for AI infrastructure.
Right.
Even if the average family is cutting back on meat at the grocery store and buying the store brand cereal.
That's it, exactly. The headline number masks the struggle happening underneath for a lot of people. So the dashboard gauge says speed is high, but it's because the engine is running on this very specific, very concentrated, high-octane fuel from big tech and, as we'll get to, government spending. It's not because all the passengers in the plane are having a good time.
And that leads us directly to the government side of the equation. Because corporate spending is one thing, a big thing, but the real steroid, the chemical that's truly changing the biology of this economy, is the U.S. deficit.
That's the elephant in the room.
Yeah.
Or maybe it's the blue whale in the room at this point. It's too big to ignore.
So let's talk about this deficit addiction. I think for most people, they hear the word deficit and their eyes just glaze over. It's just a big, incomprehensible number that politicians yell about on cable news. But you're saying this is the actual structural change that break the LEI.
It is. It's the variable that changed the whole experiment. To really get it, we have to define this paradigm shift. If you look at the data from 1948, right after World War II, all the way to 2024, the United States ran an average budget deficit of about 2.6% of GDP.
Okay, so 2.6% of the total size of the economy. That was the normal dose for, 70 years? That's the daily vitamin the economy took.
Exactly. It was a little helper to keep the grease in the gears. Sometimes it was a bit higher during a recession when spending went up and tax receipts went down. Sometimes it was a bit lower during a boom, but it always averaged out to that 2.6%.
But post-COVID, something changed, fundamentally.
Something snapped. We had the massive multi-trillion-dollar spending packages during the pandemic, which was, understandable. We had to keep the lights on when the world shut down.
Sure, that was emergency spending, an anomaly.
It was supposed to be, but the emergency ended. The spending didn't. For the last few years, we have been stuck at a deficit of roughly 6% to 7% of GDP.
So we more than doubled the historical average.
We more than doubled it, and we've stayed there. We are running a crisis-level deficit during a time when we aren't technically in a crisis. The unemployment rate is low, GDP is growing. This is when you're supposed to be saving money, not spending like a drunken sailor.
So this is why the recession hasn't happened.
It's the core reason. You simply cannot have a traditional recession when the government is pumping 6% of the entire economy's value into the system every single year as new cash. It's an artificial floor under everything. It props up demand that wouldn't exist otherwise.
But there's always a catch, right? There's no free lunch. You can't just print money forever and have everything be awesome. If that actually worked, every country in the world would just print themselves into becoming a paradise.
The catch is the multiplier effect, or more accurately, the lack of one. In the past, government spending might have had a high return on investment. Let's say you spend $1 billion to build a new highway system or the Hoover Dam. That creates thousands of jobs. It allows commerce to flow faster for decades. It generates electricity. You might get, say, $1.50 or even $2 of real economic growth for every $1 you spent.
That's good debt. That's an investment that pays for itself.
Exactly. But now, what are we spending this 6% deficit on? We are using it largely to pay for entitlements, interest on our previous debt, and just maintaining the status quo. We were in a phase of deeply diminishing returns.
The sources mention a specific number for this.
Yeah, the estimates are that for every dollar of deficit we spend now, we're only getting about 50 cents of GDP impact.
Wait, hold on. So we are losing money on the deal. We borrow $1, which we have to pay back with interest, and we only get 50 cents of growth from it.
Essentially, yes. We are burning cash just to stay still. It's an incredibly inefficient way to run an economy, but, and this is the really scary part, We can't stop.
Because we're addicted.
We're completely addicted. Think of that athlete on steroids again. He's been on them for years. If he stops taking them cold turkey, his body doesn't just go back to normal. It crashes hard.
Right.
If the U.S. government tried to go back to that healthy 2% deficit to normalize the budget and live within its means, the withdrawal symptoms would be fatal to the economy. The crash would happen overnight. We would have that hard landing that everyone is so afraid of.
So the high deficit isn't a sign of strength, it's the life support system, the only thing delaying the inevitable recession.
It is the life support system for the Frankenstein economy. We have to keep sending the shocks of electricity, or the monster collapses.
So we are on a treadmill that's moving faster and faster, and we have to keep sprinting just to not fall off the back. And we're borrowing money to pay for the energy drinks to give us the energy to keep sprinting.
And who are we borrowing that money from? The global bond market. Which brings us to the question of debt. Because if you keep borrowing at this pace, eventually you turn into... Well, you turn into Japan.
Japan. The land of the rising sun and the never-ending debt. The original economic laboratory.
Japan is the ghost of economies past, present, and future. It is the ultimate cautionary tale.
Let's pivot to Japan because I feel like for the last 20 years, literally every time someone in the U.S. gets worried about our debt, some economist pops up and says, relax, look at Japan. Their debt is way higher than ours, and they're fine.
That has been the standard argument for a long, long time. The concept of Japanification. Japan have been running high deficits and printing money for 30 years now, ever since their big bubble burst in the early 90s.
And their numbers are just staggering. Their debt to GDP ratio is what?
It's roughly 240% or 250%. I mean, it's in a different universe. The U.S. is around 120%. So the argument was always, we have plenty of room to run before we hit the wall. Look at Tokyo. The lights are still on. The bullet trains are running.
But the research we have today suggests that Japan isn't really fine anymore. They're saying the lid is starting to rattle on that boiling pot.
The lid is rattling violently. And we can see it. We can measure it in the fear gauge.
The VIX, the volatility index.
The VIX. Usually we look at the VIX for the U.S. stock market, the S&P 500. It measures volatility, or really how much investors are willing to pay for insurance against a crash. Right now, as we're talking, the U.S. VIX is somewhere around 17 or 20.
Which is calm. It's sleepy.
That's very calm. That's U.S. investors chilling by the pool with a margarita, not a care in the world.
Okay. So what about Japan?
If you look at the Japanese equivalent of the VIX, it has been spiking up to 34.
Whoa, 34. That's double.
A VIX of 34 is crisis level. That is what you see during a meltdown, during the Lehman Brothers collapse. So we have this massive glaring divergence. U.S. investors are completely relaxed, and Japanese investors are hyperventilating in the bathroom.
Okay, so why? What is Japan so scared of right now?
They are terrified because they think their bond market is on the verge of breaking. And this gets to the very nasty mechanics of the Japan trap.
Okay, we need to explain this bond mechanic because this is where it gets really dangerous, not just for them, but for us. How does a country get trapped by its own debt?
It's a classic rock in a hard place scenario. For decades, to keep their economy alive, Japan has kept interest rates at zero or even negative. When rates are zero, it's incredibly cheap for the government to borrow. They can service that massive 250% debt load easily because the interest payments are next to nothing.
Right, it's basically free money to keep the country running.
But recently, just like everywhere else, inflation has started to pick up in Japan. The cost of living is going up. At the same time, their currency, the yen, has been getting weaker and weaker. So they are under pressure to do something. They have to start raising rates, just a tiny little bit.
And when you raise interest rates, what happens to all those trillions of dollars of old bonds that the government issued that pays 0%?
This is bond math 101. It's the most fundamental rule. When interest rates go up, the prices of existing bonds go down.
Can you explain that for the non-investor listening, an analogy?
Sure. Imagine you own a bond. It's basically a piece of paper from the government that promises to pay you 0% interest for the next 10 years. It's not a great investment, but it's safe. Now, tomorrow, the government starts issuing new bonds that pay 1% interest.
Okay.
Who in their right mind wants to buy your 0% bond when they can get a brand new 1% bond? Nobody. Your bond is basically trash. The only way you can possibly sell it to someone is if you lower the price. You have to sell it at a discount to make the yield competitive.
So the value of all those old bonds crashes.
The market value craters. Now, here's the billion-dollar question. Who holds those trillions and trillions of dollars of old Japanese government bonds?
Uh-oh. I'm guessing it's Japanese institutions.
The Bank of Japan holds a huge amount, but so do Japanese commercial banks. Pension funds, insurance companies, their entire financial system is built on a foundation of these bonds.
So as interest rates rise, even a little, the value of the core assets on the books of every bank in Japan is plummeting. They are sitting on huge, unrealized losses.
This sounds an awful lot like Silicon Valley Bank here in the U.S.
It is exactly the Silicon Valley Bank dynamic, but on a national systemic scale. SVB went bust because they owned safe government bonds that lost value when the Fed raised rates. If Japanese banks are forced to sell those old bonds to raise cash for any reason,
They have to realize that loss. It becomes a real hole in their balance sheet, and they go bust. It could trigger a chain reaction, a localized Lehman Brothers event.
so Japan is terrified of raising rates because it could blow up their own banking system. But they have that other problem you mentioned, right? The currency, the yen.
This is the trap. This is the second jaw of the vice. If they keep interest rates at zero to save the banks, the yen becomes worthless. Why would any global investor hold a currency that pays 0% when they can hold U.S. dollars and get 5%?
So money flees the country.
Money flees the country, which crashes the value of the yen. We've seen the yen fall to multi-decade lows, and that makes everything that Japan has to import, like oil and food, incredibly expensive. It fuels inflation.
Okay, so if they raise rates to save the yen and stop inflation,
They kill the banks.
but if they keep rates low to save the banks,
They kill the yen. They're damned if they do, damned if they don't. They're juggling live grenades with no good options.
And why should the listener in Ohio or London or anywhere else care about the fate of Japanese banks?
Because we are financially conjoined twins at the hip. Japan is the largest foreign holder of U.S. debt. They own over $1 trillion of U.S. Treasury bonds.
Right.
If Japan's financial system blows up, if their banks are suddenly desperate for liquidity to survive, what is the one big liquid asset they can sell on the global market to raise cash quickly?
They sell our debt. They have to
Yeah.
sell their U.S. treasuries.
Exactly. And if they suddenly dump $1 trillion of U.S. debt onto the market, what happens? The supply of bonds skyrockets, the price crashes, and our interest rates spike violently. Our borrowing costs go through the roof, and that 6% deficit we're running becomes completely impossible to finance.
So the contagion lines are direct and immediate. So let me get this straight. The pilot of our plane is flying blind. The engine is running on dangerous steroids. And the co-pilot in the next seat, Japan, is having a full-blown panic attack and is holding the detonator to a bomb.
That summarizes the situation quite vividly, yes.
Wow. Okay. Now, I want to get to that shocker that we teased in the intro, because we're talking about debt and risk. And usually when you talk about risk, the U.S. is the safe haven. The U.S. Treasury bond is considered the global risk-free asset. It's the bedrock of the entire global financial system.
Historically, yes. That's been the rule for 80 years. If the world is ending, you buy dollars and you buy U.S. Treasuries. That's the playbook.
But you have a metric here that says the market, the smart money, is starting to change its mind about that. Let's talk about credit default swaps.
Okay, let's unpack CDS. It
Yeah.
sounds incredibly complex, but the analogy in the research is perfect. Imagine it as simple car insurance.
Got it. Car insurance.
You're a big pension fund. You want to lend money to a country by buying its bonds. But you're a little worried they might not pay you back. So you go to a big investment bank and you buy an insurance policy. That's the credit default swap. You pay a small premium every year. If that country defaults on its debt, the bank pays you the full value of your loan. You're made whole.
Okay, so if I want to insure a really safe driver like, say, Switzerland, the premium is going to be dirt cheap.
Correct. Very, very cheap. Maybe a few basis points, as they say, because the odds of Switzerland going bust are basically zero. It's like insuring a car that's never going to leave the garage.
But if I want to insure a reckless driver, someone with a history of crashes, a trunk full of dynamite, and a blindfold on, the premium is going to be really expensive.
Exactly. The price of that CDS premium tells you exactly how risky the market thinks that borrower is. It is the purest, rawest measure of credit risk. And here is the data point that should make everyone sit up straight. Currently, the price to insure against the United States of America defaulting on its debt is higher than the price to insure Italy, Portugal, or Greece.
Wait, just pause on that for a second. Let me make sure I heard that right. Italy, the country that is famous for having a new government every 6 months. The country that was the absolute poster child for the European debt crisis a decade ago.
Yes, that Italy.
The market thinks the United States of America is a riskier bet right now than Italy.
The CDS is trading higher for the U.S. Now, we have to be nuanced here. The actual absolute probability of a U.S. default is still calculated by the models as being very, very low. But the relative sentiment, the price of the insurance, has shifted dramatically.
Why? What on earth is the market seeing that would lead to that conclusion?
They're looking at that 6% permanent deficit we just talked about. They see a country that has lost control of its spending. But more than that, they are looking at the political instability in Washington. Every single year now we have a debt ceiling fight, where one political party threatens to default on the national debt as a negotiating tactic.
We play a game of chicken with the full faith and credit of the U.S., and by extension, the global economy.
Exactly. The market looks at that recurring dysfunction and gets nervous. Then they look across the ocean to Europe. And surprisingly, countries like Greece and Portugal have been fiscally tightening since their crisis. They've actually been behaving responsibly.
So the reckless driver is now us.
In the eyes of the CDS market, we are the ones driving the muscle car with the trunk full of dynamite, shouting at each other about which way to turn. And the market is saying, you know what? For the first time in a long time, Rome looks safer right now.
That is just wild. We are usually the country that lectures Europe on fiscal responsibility, and now the insurance market is saying, actually, we'd rather underwrite a bond from Rome than a bond from Washington.
It's a massive red flag. It's the market whispering to us that the risk-free status of the U.S. isn't granted by divine right. It's conditional. It has to be earned. And we are testing those conditions.
And it connects right back to that pilot flying blind. The gauges are starting to flicker and give weird readings. And one of those key gauges has always been the yield curve. We mentioned it briefly in the intro as another broken crystal ball, but I want to take a minute to explain it because it's usually the #1 undefeated recession predictor.
The yield curve is the most famous indicator in all of finance. And to explain it, let's go back to the bank and think about a certificate of deposit, a CD.
Okay. I go to my bank, I give them my money, and I promise to leave it there for a set amount of time.
Right. Now, if you lock your money away for 30 years, you would expect to get a much higher interest rate than if you only lock it away for 1 month.
Of course. Because 30 years is a long time, inflation could spike, the bank could go bust. I might need that money for an emergency. I need to be paid extra for taking on that risk and that inconvenience.
Exactly. That is a normal yield curve. It slopes up and to the right. Short-term loans pay a little, long-term loans pay a lot. But right now, we have what's called an inverted yield curve. You get paid more interest to lend your money to the government for 1 month, roughly 5%, than you do to lend it for 10 years or 30 years.
Which makes absolutely no sense logically. Why would I get paid less for taking on more risk over a longer period?
It implies that the bond market, the smart money, expects interest rates to fall dramatically in the future. Now, why do interest rates fall? Because the Federal Reserve cuts them. And why does the Fed cut rates? Because of the recession and the economy needs help.
So an inverted curve is the bond market screaming, recession imminent.
It screams it. It's the loudest, most reliable signal we have. And this curve has been inverted now for a historically long time, longer than it was before the 2008 crash, longer than it was before the dot-com bubble burst, and yet, no recession.
Again, the broken gauge. The indicator is flashing, but the plane keeps flying.
But there is a new wrinkle in the data that's even stranger. Recently, we've started to see instability at the very, very short end of the curve. The 1-month and 2-month interest rates are spiking, creating this weird hump at the front.
A hump? What does that mean?
It signals deep confusion and a very specific short-term fear in the market. It's the market saying, we don't just think there's a problem a year from now, we think there's a problem with the basic plumbing of the financial system in the next 30 to 60 days. It often correlates with debt ceiling fights or sudden liquidity crunches. It's the bond market stuttering.
Speaking of liquidity, let's talk about the fuel in the engine. Because we have another chart here that shows what looks like a massive divorce between the central banks and the stock market.
This is what our sources call the mystery of disappearing liquidity, or maybe reappearing liquidity from strange places.
If I look at a chart from, say, 2008 to 2021, there's a red line on it. That's the size of the central bank balance sheets, which is basically how much money they are printing. And there's a blue line, the S&P 500. And for more than a decade, they move together, they hold hands, they're perfectly correlated.
It was a direct one-to-one relationship. Money printer goes burr, as they say on the internet, and stocks go up. The Fed pumped money into the system via quantitative easing, And that money had to go somewhere. It flowed into assets like stocks and real estate.
But look at the chart now. Since 2022, the central banks are doing the opposite. They're selling assets. The red line is going down. They're doing quantitative tightening, or QT, to fight inflation. They are actively sucking money out of the system. But the blue line, the stock market, is hitting all-time highs. They got divorced.
It's a complete and total divergence. The Fed is taking the punch bowl away from the party, yet the market is partying like it's 1999.
So the big question is, where is the money coming from? If the Fed isn't printing it, who is? Where is this liquidity that's pushing stocks to record highs coming from?
This brings us back to what some are calling the shadow money supply. We can see that M2, which is a broad measure of money supply in the economy, is still growing, despite the Fed's actions. The source appears to be a massive boom in private credit and, again, corporate financial engineering.
Financial engineering. Those two words together always make me nervous.
And they should. Remember the Amazon and big tech CapEx example we touched on earlier? That's $700 billion in AI and infrastructure spending.
Right, the new engine of GDP.
How is that actually being funded? A lot of it isn't just coming from the cash they have on hand. Big tech companies and other major players are getting very creative with how they structure their debt. Amazon, for instance, might create a subsidiary structure, a separate legal entity, to issue debt specifically for its new energy projects or its AI data centers.
So Amazon, the parent company, doesn't technically have that new debt sitting on its main balance sheet for everyone to see.
It's nuanced and it's all legal, but effectively, yes. They might use a structure where the debt is tied specifically to the future cash flows of that project, not the parent company as a whole. It's a form of off-balance sheet financing. It allows them to pump massive amounts of liquidity into their operations without damaging their main credit rating or looking over-leveraged to their shareholders.
This sounds disturbingly familiar.
It sounds like 2007.
Yeah, that's exactly what I was going to say.
It sounds like the special purpose vehicles, the SPVs, that banks use to bundle up and hide subprime mortgage risk from their main balance sheets. Now, to be clear, I'm not saying it's the exact same kind of fraud. These are real data centers being built, not worthless mortgages. But the mechanism of using financial engineering to mask the true amount of leverage in the system is very similar.
So we have a stock market that's being propped up by this shadow liquidity from private sources and corporate QE, and it's completely ignoring the Federal Reserve's attempts to cool things down and remove liquidity.
And that creates a very, very fragile environment because shadow liquidity is fickle. It comes from private lenders, private credit funds, not a central bank. If those lenders get scared, if sentiment turns, that money can dry up overnight, much, much faster than central bank money does.
Okay, we've covered a lot of scary stuff here. We've got broken indicators, a deficit addiction, Japan's ticking debt bomb, the U.S. being priced as riskier than Italy, shadow money. If you're a listener, you're probably thinking, okay, if everything is so dangerous and fragile, why is the stock market going up? Why is everyone still buying?
But is everyone buying? Or maybe the better question is, what are they buying? This is where we need to look at what the smart money is doing. The big institutional whales.
Let's talk about the shrimp.
The shrimp. This is my favorite analogy from all of the research we looked at. It comes from a model that's run by Fidelity, the giant investment firm. They track the economic cycle.
And usually the economy moves in a predictable circle, right?
Right. There are 4 phases. Boom, then slump, then recession, then recovery, and then back to boom. It's the circle of life for an economy.
But recently, the Fidelity model showed the U.S. economy doing something very strange. It was moving through the cycle normally. It went from boom to slump. It got right to the very edge of the recession phase, and then it walked backward.
Like a shrimp. It started moving backward.
Like a shrimp. Instead of falling into recession, quarter 4, it just looped back to quarter 1 or quarter 2, back to the growth phase. It refused to cross the line.
Which sounds great on the surface. We escaped. We cheated economic death.
But did we? Or did we just delay it with another injection of those steroids? Because if you look at what the whales, the big institutional investors with billions of dollars, are actually doing with their money, they aren't buying the growth story as much as you'd think.
We see the S&P 500 hitting all-time highs, and that's being driven almost entirely by a handful of giant tech stocks. But if you look underneath the surface at where the money is flowing, there's a major sector rotation happening.
Correct. The smart money, the big funds, are aggressively buying consumer staples. The stock market ticker for that sector is XLP.
Consumer staples. Let's be very clear for the listener of what that is.
We are not talking about exciting, high-growth companies. We're talking about toothpaste. Toilet paper, laundry detergent, canned soup, Coca-Cola, Procter& Gamble.
Boring stuff. The stuff that people have to buy no matter what happens to the economy. If there's a deep recession and you lose your job, you buy a new Tesla. But you still brush your teeth. You still wash your clothes. You still need toilet paper.
So when the big, smart money funds start piling into consumer staples, it is a defensive play. It's the financial equivalent of building a bunker and stocking it with canned goods.
It is the most risk-off move you can make within the stock market.
So the headline number of the S&P 500 says, risk on, party time, because everyone is watching NVIDIA go to the moon. But the actual buying behavior of the smart money under the surface says, hunker down, buy soup, a storm is coming.
It's a classic bearish divergence. The index itself is aggressive, but the internal positioning of the market is deeply defensive. The institutions are hedging their bets. They are riding the tech wave because they have to. If they miss out on those gains, their clients will fire them. But they are secretly packing a parachute and an emergency kit.
Which is probably a very smart move given everything we've discussed today.
Absolutely. It's the only rational response to the Frankenstein economy we're living in.
So let's try to land this plane. We've unpacked a lot of different confusing pieces. Let's try and synthesize this for the listener into one coherent picture.
The picture, I think, is this. We're in a Frankenstein economy. It is being kept alive, kept walking by massive high-voltage shocks of government deficit spending, that permanent 6% deficit, and a huge wave of corporate spending on the AI revolution. This spending has completely broken the traditional warning gauges like the LEI and the yield curve. They're flashing red, but the money hose is just too strong to let the system correct itself.
But the cost of keeping this Frankenstein alive is that we are building up massive, unseen structural risks under the surface. We have normalized a deficit that our own insurance market says is unsustainable. We're now seen as riskier than Italy. And our biggest foreign creditor, Japan, is teetering on the edge of its own currency and banking crisis.
And all the while, the liquidity that's propping up our stock market is moving into the shadows of private credit and financial engineering, making it harder to track and much more fragile.
So what does this mean for the listener? The person with a 401k or a pension or just a regular savings account? What's the so what?
I think the first thing is that the standard diversification rules might not work the way you expect them to. Traditionally, you buy U.S. Treasuries to be safe. But if the CDS market is right, and if inflation stays sticky because of this permanent high deficit, Treasuries might not be the pristine shield it used to be. You could still lose purchasing power.
And the safety of the stock market is also pretty questionable if the entire rally is being driven by just 7 companies and a mountain of shadow debt.
Exactly. The lesson here, I think, is to look beyond the headline numbers. Don't just look at the S&P 500 closing price and assume everything's fine. You have to watch the plumbing. You have to watch the yield curve. Watch what the U.S. dollar is doing. Watch what the CDS market is pricing in. Watch that deficit number.
And I think the final provocative thought here is about that new paradigm we asked at the very beginning. Is the crystal ball broken?
My fear, and the fear of many of our sources, is that we are all just waiting for the data to revert to the mean, for a massive crash that finally aligns the reality with the indicators. That's what usually happens. Eventually, economic gravity always kicks in.
But there's a but in your voice.
But the alternative is even stranger. Maybe we have to burn the old textbooks. Maybe permanent high deficits and the political will to never allow a recession have fundamentally changed how gravity works in economics. Maybe we have entered a new phase where political will, the willingness to print money forever, can suspend the laws of economics for far longer than any of us think is possible.
The ultimate question. Can we actually print our way to prosperity forever? Or does gravity always win in the end?
History would suggest gravity always wins. Every empire that has tried to debase its currency to pay its debts has eventually faced a very painful reckoning. But we, as a global economy, seem absolutely determined to test that theory to its absolute limit.
Well, on that cheerful note, thank you for flying with us today on the deep dive. Please keep your seatbelts fastened because the turbulence probably isn't over yet.
Indeed. Stay curious, everyone, and keep watching the data.
We'll see you next time.